Assalamu alaikum. I apologize for the delay. On behalf of Imam Tariq El-Amin, resident Imam of Masjid Al-Taqwa, and the Ta'aleem Committee Chair, Dr. Dr. Aisha El-Amin, the committee, Randall Allen, and myself, Rashida Fitzpatrick, and Dr. Gloria Bashir, I want to welcome you to today's Ta'aleem. Today's presenter is Randall Cox. Mr. Cox is a chartered life underwriter and is considered extremely knowledgeable in the area of life insurance. He has been with Country Financial for nearly 20 years and offers a variety of insurance products, including home, auto, and business, in addition to life insurance options. Mr. Cox is also a registered representative of Country Capital Management Company. He can help individuals plan for their financial future. As a Country financial insurance agent, he is prepared to help individuals with insurance options to protect what and who they love the most. Without any further ado, I would like to introduce to you my insurance agent, Randall Cox.
Good afternoon, everyone. Hi.
Good afternoon.
I'm Randall Cox. I've been with Country Financial for almost 20 years now, and I am fully immersed in the area of life insurance and estate planning. Those are the things I kind of care about the most. Home and auto. I mean, we have really good rates, but they come a dime a dozen. But what's most important to people nowadays are their assets, their family, and what's going to happen when they're not around anymore. So I'd like to spend maybe about 20 minutes discussing estate planning, and then I can spend another 20 minutes or so discussing the various types of life insurance, and then I can take some questions after that, if you don't mind. You can stop me anytime. If you have a question, just stop me, and if you don't want to forget it, you can ask me. I have no problem with that, okay? So first topic, estate planning. So most people don't do any estate planning. I just, 1 out of 20 of my clients has a will, and maybe 1 out of 40 has a living trust. A lot of people have life insurance, but only 60% of people have life insurance, even though 90% of us say that we need it. But estate planning is important if you have assets. And there is a growing controversy between living trust versus a will. And I'll kind of give you some insights on the differences in those two things, because they are different, but they're similar in certain ways. So a living trust is where you specifically get to name who you want to get what you have when you die while you're alive. You can make changes to it. You can you have to assign a trustee. You are the beneficiary of that trustee, or you can make other people beneficiaries of a trustee, certain elements of it. You might say, I want to be the trustee over my home, but my bank account, I'm gonna make the beneficiary of my bank account my son or my daughter, but I'm gonna be the beneficiary of my home. So the real differences between a will and a living trust is a will can go into probate court. And a will is simply when you decide who gets what when you die. So I wrote a couple of notes down. There's a lot involved in wills and trusts. I'm going to give you a couple of key points. So, like I said, a will can be contested in court, in probate court. For instance, if you died and you had 2 kids and you left your $50,000 in your bank account to one kid and didn't leave the other one anything, the other person could contest the will in probate court to see if that will was done properly, to see if there was any issues with the way the will was handled. And if they find a problem with the will, the court will then assign equal shares to both of the living children of the descendant. If the will is done correctly, however, then the court's going to say it was done correctly and you decided to give John this money and Joan that nothing, or vice versa, and that's how it goes. Okay, so will can go into probate court, and will go into probate court where a trust, a living trust, avoids probate court. So yeah, the trust protects the possessions and minors. A trust is going to protect minors. You know, like if you have minors and you pass on, you want to have that trust stay with the trustee, so that when your minors are of age, they can then be given the assets that you directed the trustee to give to minors. So that's very important. If your kids are grown, you less likely need a trust unless you just want to make sure that it doesn't go to probate court. So you are the seller of that trust. You give the trustee the responsibility to hold and manage your property and your assets, and according to your wishes. So you want to avoid the probate process by having a living trust. A living trust costs more money, typically between $1,500 and $3,000, because it's more complex, there's more involved, there's more paperwork, there's more certainty to who gets what in a living trust. A will's normally between zero. If it's a family member, they might not charge you anything, but normally you won't pay more than $1,000 for a will. But most people don't have a will or a trust. It's like, you know, most people just, you know, they just think when something happens, oh, well, my kids will get everything. And the courts take so long to deal with this situation. And guess who's going to make a lot of money? The lawyers. So to avoid the attorneys and probate, a living trust is absolutely better than a will in that respect. So a couple things. What's a will? It's a legal way of you deciding who gets what. Now, will is important to determine what to do with minor children. So that's something that a trust is not going to do. The trust is going to protect against the minor children not getting anything until they become of age. But a will, if you only have a will, it's going to let the court know what to do with my 15-year-old, my 9-year-old, who I want to be the guardian of my children. So that's very important. So that's why some people have a will and a living trust, because they work together to do some similar things, but they're a little separate in some regards. So will's straightforward and simple. Here's what I want to go to this person, that person, if I die, and my children, I want them to be a certain person to be the guardian. So there's about 5 or 6 different kind of wills. There's only 3 main wills that people ever use. Nobody ever uses an oral will anymore. It used to be an oral will. You record it, the attorneys, and there's everybody there to sign that they heard what you wanted done. That was old school back in the 30s, 40s, 50s. Most people don't use oral wills. People want it in writing. A simple will is in writing. You're writing down what you want done, who you want to have your assets when you die, and who you want to take care of your dependents. A joint will is a spouse document. So you can decide that together who you want all the assets to go to. And if one person passes on, the other surviving spouse has possession of all the assets and can then adjust that will to be a simple will for one person. A living will is different than a living trust. A living will is simply you want to outline your medical wishes in case you become incapacitated. You want someone to decide your medical care, when to take you off the machine that's keeping you alive, or that type of thing, the type of care you want. So very good differences between wills and trusts. So a couple questions and answers. I'm going to ask a question myself a rhetorical question. I'm going to answer it, and then you'll be able to ask me a question. I'm not giving any legal advice because I'm not an attorney. But the basic difference between a will and a trust is that a will typically goes into probate after the testator dies. They call you intestate when you die without a will. That's the phrase, intestate. So if somebody, have you ever heard someone says this person died intestate, didn't have a will? It's going to go through the courts, more than likely, unless there's only one surviving child or next of kin is known to be a only sibling or whatever. So big difference. Will goes into probate, trust does not. So why is a living trust better than a will? Well, it lets you facilitate the transfer of your assets to your heirs without the cost of probate, and it's quicker. Since there's no court involved, it gets the trustee, whether you use a bank or whatever institution you use to be a trustee, they facilitate the assets right away. Bank account goes to the person who's supposed to get it, the car, the house, whatever. It gets done a lot faster. No court involved. Okay. What is the disadvantage of a living trust? Well, it costs more. And also, if it's a revocable living trust, which means you can make changes at any time to it, it is not free from assets from lawsuits or creditors. So a living trust, because you still have control over the assets, so a living trust can be, people that are your creditors, you can be sued for liability, and those the assets in your living trust are not protected. If you have a unrevocable living trust, those are the kinds where you make the decision who gets what when you die, and you can't make any changes, then those assets are protected from creditors and lawsuits because you don't have any control over the assets anymore. And there's also some tax advantages to a irrevocable living trust, they call it. Not unrevocable, irrevocable. So the tax advantages are that, when you have assets that you give someone, they may have to pay capital gains taxes on those assets. But an irrevocable trust where you can't make any decisions to change anything, you usually have more favorable tax advantages. And you would have to talk to a tax attorney or an accountant to know exactly what those are. I just know there's advantages to have an irrevocable trust because you can't change anything. So, and then so a couple more points about trust. What are the negatives to a trust versus a will? Well, we talked about the disadvantages because of the cost, and that's the main one. It costs a lot more money. But of course, there's a lot of advantages to having a living trust. Now, here's an important topic. This is a case where a living trust allows you to specifically say what your beneficiaries are going to get and when they get it. Where a will, if you have $100,000 in the bank, 50,000, whatever, you're giving it to your son or daughter, they're going to get the money. They could lose it all in Las Vegas the next weekend. That probably won't happen, but if you have a trust, a living trust, you can specifically say, when my son John turns 18, he's to only get $5,000 a year for the next 10 years until the money runs out, or whatever. You can specifically make sure that they don't blow all the money. So living trust you can control how your beneficiaries get and spend the assets that you give them. So that's why they cost more, because there's a lot more paperwork, a lot more details in a living trust. So in the capital gains, if you keep an asset in a living trust for at least 1 year, so you say you do a living trust and you are putting your car, your bank account, your whatever, as long as that asset's in there for at least 1 year, you can still avoid some capital gains taxes, but not all of them. If it's a revocable trust, you might still pay some capital gains. Your beneficiary will when assets are transferred. But if the asset's there for 1 year, you can avoid some capital gains taxes. That's the IRS codes keep changing that stuff every year. So basically, revocable trust can be changed at any time as long as you're competent. And an irrevocable trust can't be changed only in certain circumstances where a court order is used to change irrevocable trust in certain cases, but normally it cannot be changed. So there are the main topics in discussion for trust, which I say most people don't have. And I think it's important. So I will be happy to take questions about trust now before I go into life insurance. And if I can't answer that question, at the end, I want to give you guys my email, my business email, and my cell phone number so you can reach out to me. I do want to be able to email everybody some more information on these topics that you can have in case you didn't remember everything, you're not taking a lot of notes. So at the end, you can ask me questions with my, you can email me questions also. But if you want to ask me something right now, I'd be more than happy to answer, or I can move on to the other topic.
Mr. Cox, I had a question. Is
Sure.
there a difference in how much you pay if it's an irrevocable trust versus a revocable trust?
No, there's no difference. The paperwork is not going to be, there's no more time involved in doing either one of them except the word irrevocable versus revocable. And
Okay.
so I would say, if in my opinion, if there's any small difference in price to do it, a irrevocable trust is going to be less expensive because you can't make changes. So a revocable trust, I think, may cost a little bit more because you can year to year to year, you can call up the trustee and you can make changes. I decided to add another nephew. I decided to change the amount I'm giving my. So I think they charge you for changes made, but the actual cost to start it, to get it done, is about the same, but you would have to pay separate charges for making lots of changes or changes throughout the course of time. But irrevocable trust, it's done. It's set. You can't change it unless you go to court and have a judge have a good reason why they should change that trust. Good question.
Okay. So what type of assets um would you have to be considered? I mean, for you to even consider a trust, would it just be if I have a car, I have a house, and I have life insurance, I should have a living trust?
Right. Now, okay. Now, life insurance, the beneficiary of that life insurance, that's the unique thing about life insurance. I'll get into it later. That person's going to get that money regardless of a will or a trust. You don't have to have a will or a trust. Life insurance is straightforward. You're going to get that money. Creditors can't come after it. Lawsuits can't touch it. Life insurance is a unique vehicle. However, in a trust, cars, furniture, bank accounts, all of that stuff is going to be a pertinent things that you want to put inside of a trust. There is some kind of hesitation, they say, about putting the title of a house in trust, but that's something a trust attorney or an estate tax attorney would have to tell you about. There's there's some disadvantages or advantages to actually putting the title of your house in a trust, but people do it. But definitely all your liquid assets, stocks, bonds, cars, that type of thing, things that you own that when you die, you want to give specifically to someone else or to charity.
Okay, I
So
got a question. It says, can you explain the benefits of Illinois real property transfer in death instrument or death insurance? I'm not sure if she mean insurance.
death insurance, you mean life insurance?
Well, that question is, can you explain the benefits of the Illinois real property transfer in death instrument?
I know what they're asking. That's something I'll have to get back to you on.
Okay.
All right, hold on, write that down. Give me the middle of that was real property, what?
One moment, I gotta pull it up again. I'm sorry. I was looking at you.
That's a real technical one there. I've heard that phrase before.
Okay. Sister, can you read the question again? I'm having a problem finding it in the chat. Samir.
That's one of them.
Assalamualaikum.
Walaikum assalam.
It's called the Illinois Real Property Transfer on Death Instrument, abbreviated transfer on Death Instrument, abbreviated TODI.
Okay, I'll find out about that. Okay, I've heard of that before. Yep.
Okay, thank you.
Okay. Yep, that's a very specific thing. So yes, I'll get back to you on that one. Okay, that's one where I'm gonna want to have that person who just talked to me about that get my email and email me so I can email you back, because I won't know how to email you back if you don't email me. Okay.
Okay.
Thanks for the question.
All right. Thank you. Assalamualaikum.
You're welcome.
Okay. If we don't have any other questions,
yeah, I have a question.
Oh, go ahead.
Sure.
Yes, Mr. Cox, I know you mentioned that most people don't have trust and wills.
Mm-hmm.
And I guess one reason could be that they don't know or not aware of. Then what would you say the other reason would be that people, because many people who don't consider they have assets? And I know you mentioned something about assets.
Question.
Yeah, and specifically too, when people have homes, and many of us have homes, and many of us still have mortgages on them, how does that fit into that aspect of the will and trust with a home that still has a mortgage still pending on it when the person deceased?
Good question. Good question. Okay. So to answer your first question, the main reason why people don't have wills or trusts is there's too many reasons. They don't know about it, as you brought up. They don't know about it. They don't know. Most people, if you said what's a will, they kind of know what that is. People have heard, they've seen enough movies to see that, they've heard the word will. Oh, that's something where you give everybody stuff when you die. I'm just being like plain and simple. But the other reason why people don't have one is the reason why they don't have life insurance. Is they procrastinate and they don't think they're going to need it. No one expects to die. Everybody thinks they're going to live to be old and gray. That's just the way I'm writing life insurance policies for people in their 60s and 50s all the time until they start going to a bunch of funerals and realizing they need some life insurance. But the other reason, other than not knowing, is they procrastinate and they don't want to spend $500 on a will or $1,500 to $2,000 on a living trust. Financial reasons too. I guess that's the third reason. They don't know about it. They don't think they need it because I'm only 30. I'll worry about that when I get 60, when I'm about to die, when I'm 70 or 80. When of course we don't know the time or the place when we're going to die. But so that's, and the third reason is they don't want to spend the money. If I talk somebody into getting a trust, hey, you need a friend of mine, I could say, hey, you need to get a trust. You own 2 rental properties, you got this, call this person. Now, I don't like recommending anybody when it comes to lawyers, I don't do that. But just hypothetically, when they call and say, how much is this going to cost? $2,000? Okay. Well, they're not gonna pay it. Now, some people do. You know, most people in my family have wills and trust because, you know, that's what I do. And I tell everybody. Everybody don't have one though. So, but good question. Those are the three reasons. They don't know about it. They don't think they need it, and they don't want to pay for it.
He also asks what
Oh,
happens.
yeah. Well, the mortgage, yeah. So if you have a mortgage on your home, you can still put your home in trust. The beneficiary of the trust is going to be the lien holder, the mortgage company. You know, the sale of the home, the mortgage company gets their money first before anybody else gets anything. So yeah, you can have a mortgage on a home and still put it in a living trust. And the order of succession, number one, the lien holder of that mortgage company is number one. And then everybody else comes after that. And so most people do have mortgages. So yeah, the living trust can be done with a home that has a mortgage on it. And but there are certain estate attorneys that won't want you to put your home in trust. They got another instrument. I can't think of what it is, but I'll email you guys about it. There's another thing you can do with your home. It's another type of trust instead of a living trust. I can't think of the name of it right now. There's another kind of trust that attorneys use specifically for real estate property. But sometimes they'll throw the homes into the living trust also. And if I think about that word for the homes, I will let you know. But let's say I'm not an attorney, so I just know it from being you know, a CLU and having to know all of this stuff. But I don't practice it because I'm not a lawyer, so I've never set up a trust for anybody. But good question though, very good question. All good questions.
Yeah, Mr.
All right,
Cox.
put your
I have
information.
one other question.
Go right ahead.
In relationship to it. And when I was when I was asking about that question about the mortgages, how homes with mortgages and being in a trust, and I guess this is in an insurance area too, because when a person passes, there's a mortgage, there's still payments to be made on that mortgage.
Mm-hmm.
And how can a person protect themselves? Because if you know if a person dies and there's no planning for that home, and we talk about, you mentioned being sold, how a home may not be able to be sold right away.
Okay.
And in your area as a financial planner, how would a person plan for situations that occur like that?
That happens a lot. I get people that pass away, and the daughter or son will call me and say, "My mom passed away. I know she had home insurance with you." No, I'm answering your question, but I'm giving this example to help answer the question. So you obviously, if that mortgage is in one person's name and they die, no one can. You can't just take over mortgage payments. Now you can, because most mortgage companies don't care who pays the mortgage. However, what if there's a claim? And there's a claim and it's $20,000 worth of damage done. The insurance company is going to write that check to the person's name that's on that mortgage, that's on that insurance policy. So you can't cash the check unless, to answer your question, you need to get an attorney to give you an inheritance deed. You've heard of a quit claim deed. When I have a paper home and I just want to give it to my son or daughter or whoever. An inheritance deed is when you die and you have a mortgage. Typically, an attorney will go to court and get the judge to transfer the owner, the title of the house into the descendants beneficiary, and then the mortgage company will normally accept an inheritance deed to add that person's name on the loan. Without that, they're not going to just put your name on a loan. You'd have to actually sell the property without getting the title changed over. So it's kind of a complicated situation when people die all the time with mortgages. But I have to tell my client, look, you can continue to make the payment on the insurance, but I can't leave the policy the way it is, because what if there's a claim? Check's gonna be made to your mother's name and you're not gonna be able to cash it. So what we do in the insurance business, I changed the name to the estate of Mary Jones or John Johnson. My company allows me to do that because then if the beneficiary of the person that died has either been named the person that's taking care of everything, if there's a word for whoever's handling the estate for the parents for that person, they can then cash that check because it'll be whoever the bank is that has that check written on their bank account, they will allow the person that's the executor of the estate to handle things like that if there's a check having to be written in the person's name that died. So there's a lot to it there. It happens all the time. People die and they have mortgages, they have insurance, all of that stuff has to be settled. So, but an inheritance deed is the easiest way to put another person's name on the title, and the mortgage company will usually let them continue to make payments and let them be a part of the mortgage loan going forward. Hope that answers your question.
I'd like to just add this to our audience, Muslim audience, to that, what Mr. Cox give us about delaying, and we don't think we're going to die. Our guidance is given to us. It said, live every day as if it's your last day.
Absolutely.
Plan it like you're going to live 1,000 years. And also, we are told too in our religious guidance that we should have a will and we shouldn't wait no more than 48 hours before we do that. And I'm a guilty party when I said that. Okay. I'm finished.
Okay.
I just posted your email address and your website information in the chat. So if anybody has any questions that they want to ask, but if you want to go on and try to explain the benefits of life insurance.
Yes, I'm going to roll right into that. Okay. Okay, so only 6 out of 10 people have life insurance, but 9 out of 10 say that they need it. And another reason for life insurance, people not purchase life insurance, everybody knows about life insurance. I mean, you could be like just in high school. You could ask a high school junior or senior, have you ever heard, do you know what life insurance is? Because their parents talk about it. Everybody talks about life insurance, but people don't think they're going to die. I got one at my job, which is not a good reason to not buy a policy, because that's a group policy that ain't typically, it's not going to stay with you when you leave or retire, or they just really don't think they need it. So let's get into life insurance real quick, okay? So I know I've only got a certain amount of time to talk about this. I'm gonna roll right through it. So everybody knows what life insurance is and why we need it. But so you need it if you're married or getting married, if you're a single parent, if you're changing jobs, because you may have a group policy at this job. That happened to one of my clients. Mr. Cox, I need a policy. I just got another job and they don't offer insurance like the other company did, even though I had already told that person several years back that you need your own policy. Don't worry, don't rely on the one that you got at work. But they ended up doing another one with me when they went and changed jobs. So if you're about to retire, if you just are stubborn enough not to buy one, and I do have people that retire, Mr. Cox, that insurance is going to run out. I'm retiring at the end of the summer. I need to try to get some life insurance. And so now it's going to cost you a whole lot more because it's based on your age. We all know that. Now, if you're single, most people think single people don't need life insurance. But yeah, you do. You don't want to put the final expense burden on your family. And if you didn't want to leave a mortgage or credit cards left for your estate to have all this debt, at least a final expense policy if you're single. Now, I got some single people that will that bought large whole life policies from me. I'll get into that in a minute. Excuse me, because it builds a lot of cash value. And the single people that are self-employed that don't have a retirement plan, they bought lots of life insurance where it has builds up a lot of cash value. I'll get into that in just a second. So moving right along, how much insurance do you need? Life insurance is a number. Some people say, I just want to pay off my mortgage if something happens to me so my wife doesn't have a mortgage. Or I just want to make sure my kids go to college. I just want to have, or I just want to make sure I have a certain amount of years to replace my income so my wife can, you know, she's not going to lose my income. Or you could be like me and all of above, because I have a lot of life insurance because I want to make sure the mortgage is paid off, kids in college, wife has enough income to sustain the same standard of living. So everybody has their reasons why. So, but if the immediate expenses for life insurance are funeral, medical expenses, mortgage, car loans, credit cards, taxes, there's estate taxes. When you die, now if you're married, then you don't have to worry about that because your spouse is going to continue to live in the house, probably not going to sell it, da 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 da. But if you're single, then there's estate taxes for when your home is sold, you know, there's capital gains that go to the beneficiary if you didn't have a living trust. Another reason for a trust. Ongoing expenses that are not immediate are food, housing. This is leaving a spouse. Food, housing, utilities, transportation, healthcare, insurance, that type of thing. And future expenses are usually limited to like college or retirement planning. So, you know, you got to think about what you want. When someone says to me they want life insurance, the first question I ask is, what do you want it to do for you? Do you want to pay off a mortgage? Do you want to send kids to college? Do you just want to make sure you leave enough money for your husband and wife to continue on the same standard of living, or a combination of those three, or all of above? That will give me an idea of where do I start with the amount of insurance that I'm going to show you that you might want. And another way I can start doing it, sometimes people just don't know. They don't know what number to pick. They don't know what number. Do I need 500,000, 300, 700? Sometimes I'll say, give me a monthly payment that you are comfortable with, that wouldn't, you know, break up your budget, that you're comfortable with. And then I can work that number and give you options of what type of insurance plan you might want. So getting into insurance plans, and I'll need about 10 more minutes. We're done. So you definitely want to take advantage of a policy at work if you got one, because it's a group policy. It ain't going to cost a lot. And you want to take advantage of it as an addition to having your own personal policy. Everybody needs to have their own policy. Okay, so now the different types of policies is the last thing I'm going to talk about, and this is kind of important. This gets to be a really great area where people don't have a policy they want, and I can help them through that. Term insurance, and most people know what that is. It's for a certain term. It's the least expensive type of insurance policy. It's either 10 years, 15, 20, or 30. That's typically what most companies will sell a policy for. You cannot buy a term policy, I don't know anywhere you can buy one, where you're going to be over 80 years old. I got a couple right now. She's 66. This is just a couple of days ago. He's 63. I could do a 15-year term for him because he'll be 78 at the end of the 15 years. I can only do a 10-year term for her because she's 66 and she would be 76 and she would be over 80 with a 15-year term. So they're not going to do a term policy because everybody's living longer. My mom passed away at age 93 about 4 years ago. Only 5% of all term policies written in this country, you can Google it, you know, with your phone. It may say 3%. I'll say 5%. Ever pay a beneficiary, because most people outlive the term. But term comes in handy when it's the only one you can afford, because it's the least expensive, it's the least amount of benefits. If it's the only one you can afford, Or if it's a young couple starting out and, you know, they just got a mortgage and the baby's on the way and they just don't want to spend a lot of money, they're in a starter home. I can understand buying a term policy and then maybe upgrading to a permanent policy later. Permanent policies, there's two different kinds. Whole life, in my opinion, which is that's the best one. That's my opinion. But there's also an index universal life policy. You may have heard of that. You may have heard of universal, index universal. Those are policies where you can vary the premium that you pay, but the policy cash value is usually associated with, like in our case with my company, the S&P 500. So the cash value, the S&P 500 over the last, I don't know, 30 years has been between negative 33 in the year 2008 when there was a recession. We're not counting that year. Typically, when there's not a recession, it's usually the last 15 years, I think it's been average between 3 and 6%. So our illustrations show 5% of the illustration, the cash value is based on 5% S&P 500. I can explain that more in detail one-on-one with you guys, but whole life insurance have nothing to do with an investment vehicle. It is the company profit. Our company has dividends that we pay in these policies every year, and we pay dividends for like 100 years in a row. I've got my insurance with my company, and I know they're going to be around. We're rated A+ every year for the last 100 years. So whole life is a death benefit that grows every year. The term insurance is different. If you buy a $250,000 term policy for 20 years, it's going to be $250,000 for 20 years. Although we do have a term policy with a return of premium rider, we add a little bit more premium to the payment, but at the end of the 20 years, you get all your money back if you're still alive. Or if it's terminated for any reason, you would get all of your premium that you paid back. I'll write a few of those. Write more whole life because it's pure permanent coverage, costs more than term, but the death benefit grows every year and the cash value grows every year, and the cash value is tax deferred. The IRS can't tax you on borrowing from the death benefit, from the cash value, which I've done many times. And they can't, no one can, the tax code of the United States, IRS tax code, can tax you on the death benefit of life insurance. That's why it's an excellent vehicle to leave assets or money to your beneficiaries. You cannot be taxed on it only in one instance. That's if you're an executive, say for a company, and your company purchases the life insurance. Then your beneficiary gets taxed at her regular tax rate, his or her regular tax rate on the death benefit because you didn't pay for the insurance. So executives do get their life insurance paid for on occasion. And so there's a beneficiary that gets taxed on the life insurance. But most of us who aren't executives, and that's 99% of us, it goes to the beneficiary tax-free, and the creditors can't come after it. None of that stuff. IRS doesn't tax it, and the loans that you borrow on the cash value cannot be taxed. And index universal life is similar to whole life. It's permanent. It grows cash, but the cash is based on how the S&P 500 does. But we have a floor. Like I said, negative 33% back in 2008. But our floor is 0. So you cannot go less than 0 gain on our cash value S&P. Floor is 0. The maximum is 8%. But the illustration that we give everybody is based on 5. We max it at 8 because we're giving everybody the benefit of not having that, of having that floor of 0. And payments can be changed on universal index universal life. You can have a $200 a month payment. Next year, if the S&P did well, you could actually lower your payment to have the same death benefit, or you can raise your payment if you want more cash value. You can change the payments. I write 8 out of 10 policies I write are whole life. And 1 out of 10 are term and 1 out of 10 are index universal life. And so term policies, you're gonna outlive it most of the time. And then universal index policies, in my humble opinion, I just don't like tying in investments with life insurance, even though it could work for you in a positive way. Whole life, you don't worry about it. You're gonna get that cash value growing every year. Death benefit is gonna go up. You also have a terminally ill rider and a chronically ill rider on the permanent policies, where if you are chronically ill, meaning you can't do 2 out of the 6 basic necessities in life, bathing, eating, toileting, the 6 of them. If you can't do 2 out of 6, and your doctor says you're chronically ill, our policies, you can start using the death benefit while you're living for medical expenses. You can start using it. There's a calculation of how much you can use per year. Terminally ill. Some people say terminally ill means the doctor says you might not live more than 2 years. He or she may say more than 1 year. Typically, it ain't gonna be more than 2 years. If you're deemed terminally ill, you can use the death benefit on our policies to start using it while you're living. So life insurance is important. When I write a policy, I don't collect any money. You e-sign the application, and whatever requirements thereof are required, whether it has to be doctor's records. We don't even do doctor's records for people 50 and under, unless you are on a lot of medications and they're gonna write the doctor. But we have accelerated approval up to 500,000 on people 50 and under, where I can get the policy approved like within 2 or 3 days if they see that you're not on a lot of medications. If you're over 50, you're gonna have to have a person come out. I send somebody out to get your height, weight, blood pressure, pulse, all that stuff. But I don't collect any money, so we wait till the policy gets approved. Then you come to me and say, okay, you told me it was approved, and then I say to you, you don't have to take this policy. You can change your mind and take that one, or take more or less. So I want the process to be as less stressful as possible on life when it comes to life insurance. We don't lock it in to the day you make your first payment. I really don't have anything else to add to that. I know we're running out of time. Any questions?
Make a comment on the 2 types of policy, the term and whole life policy.
Yes.
I have worked in the financial industry field. Started off too as a life insurance agent, and I know that whole life insurance is a stable in the industry. But for young people, especially young people of not means, and they have a growing family, a home, children, young children that are going to grow up, and as you mentioned, we don't know when we're going to pass.
Mm-hmm.
That they're going to get more coverage at much less cost with term insurance, and I think people should be aware of that when we're purchasing life insurance. As you mentioned, there's different reasons why they buy, and for most people, for families, for young families, they want to protect their family. We call it life insurance because people are going to be living after you die, and those breadwinners. And 2, we have 2 now. We have in our society now 2 breadwinners. Not only the man used to be the main breadwinner, but we got both husband and wife.
Yes.
Can you speak to that aspect in the planning for life insurance?
Absolutely. Absolutely. Pardon me?
We have about 1 minute remaining.
Here I go. I'm gonna answer that question real quick. Okay, I did mention earlier in the life insurance discussion that young families starting out would be a good reason for someone to do a term policy. However, when I have a case like I had the other day, he makes 100,000, she makes 60. I do adjust the type of insurance and the amount adjustment recommended based on the replacement of income. So that's how I handle that. Sometimes they want the same amount, but sometimes because you're really replacing your income is what you're doing. So sometimes it's based on the amount that and I've got a lot of women that make more than a man. So it depends on who makes the most. They may have a need for more life insurance than the person that makes less money. So that's how I normally go about it. But again, it's up to the customer. I recommend anything I want to recommend, but I always let them know you're in charge and you tell me what you want.
All right. Well,
thank you for your time.
You so much, Mr. Cox, for sharing your information with us about a very important topic. As I said earlier, I have Mr. Cox information in the chat. If anybody would like to reach out, his email address is in the chat, and his website, his agent website information is also in the chat.
And you're free to put my cell number on there also.
Okay.
Yep.
All right.
And thank you so much for having me, and everyone have a blessed afternoon.
You do the same.